Hi everybody, good evening and welcome to the first of 5 main revision webinars covering the OCR F585 toolkit release for June 2016. The aim of these sessions over the course of 5 revision webinars is to really try and get into the detail of the extracts, really try and harness the essence of the economics, as well as thinking about the all-important exam technique at the same time. So hopefully these sessions will be useful for you and you'll pick up a lot of general contextual information and solid economics revision. So this session tonight is going to focus purely on extract 1, which is entitled The Economics of Globalisation and World Trade. It's important ahead of the exams in June to be really clear what the key terms are and how you can define them precisely and accurately. And don't forget to be able to go through this presentation again at your leisure in the future. But here are some of the key definitions which I think are linked to extract 1 in particular. Good definition of globalization, an understanding of concepts such as comparative advantage and how that differs with absolute advantage. So how do we define globalization? The key word I think is that globalization is a process. It's an ongoing process in which countries become increasingly integrated with each other and increasingly interdependent on one another. The OECD has a slightly more detailed, rigorous definition of globalization. And the key here, of course, is that they focus on geographic dispersion of manufacturing, research, sourcing of inputs, production, logistics, and distribution. We live in a world of vertical supply chains. I'll say something more about that in a second or two. And that's really key to understanding how developing countries can better harness some of the benefits of the globalization process. The extract talks about globalization and picks out 3 important aspects of them. One of which is an increase in trade to GDP ratios, which have been going up for most countries. But there are, of course, many different aspects of globalization. We see, for example, a huge rise in financial flows between countries. For example, movements in equities, people buying and selling bonds, banking flows across national borders. So capital flows have grown as well as trade in goods and services. We've seen a big increase in foreign direct investment. And increasingly, a lot of that FDI is going from emerging countries such as China and India towards the developed world. So, for example, Geely in China buying Volvo in Sweden. It's also going from developing countries to other developing countries. The rise of what we call South-South trade and South-South investment. Another aspect of globalization is we see the rise of truly global brands. And increasingly, we're starting to see the emergence of significant globally scaled businesses from emerging countries. From China Telecom, for example. This is really quite important. Many of the lower income countries don't quite have those globally scaled businesses at the moment. Can they find them? Globalization is also a process of specialization, yes, but a deeper specialization of labor. In other words, if you take something like an iPhone or an iPad, components come from many, many different countries, many different suppliers. There's very deep specialization across supply chains. And we're also seeing, as part of globalization, the emergence of exciting, important, significant new global supply chains. China, for example, is trying to establish through significant infrastructure spending what they're calling a new Silk Road, a new Silk pathway of trade and investment within the emerging world. So globalization is a long-run process. It's a fast-changing world. And your OCR 585 syllabus is really going to focus on many, many different aspects of that. Taking a look at the specific part of the extract, which I normally put in the left-hand side of a slide here. So the globalization, they've chosen 3 aspects of that. The rise in trade as a share of GDP, the increase in FDI flows, including mergers and acquisitions, as well as physical investment. And crucially also the significant increase in the number of migrant workers. Now the economics of remittances and migration is a real focus in extract 4. So we'll come back to that in a future session. Just to bring you up to date a little bit, the actual level of world trade in goods and services as a share of GDP has been rising, but it actually peaked in 2008, the year before the global recession. Since then, it's actually fallen. It fell very sharply in 2009, as you can see, from 53 to 43%. It recovered in 2011, but there are signs now actually that world trade is slowing down again. And some economists are saying that actually we've reached the end of peak globalization for the moment, at least. The extract then goes on to talk about some of the benefits of globalization from the point of view of a national economy, but also from the aspect of the world economy. And it clearly brings into play what I hope are some familiar concepts: specialization, division of labor, and crucially, the idea of comparative advantage. This isn't the time and the place in this webinar to go through the entire theory of comparative advantage. There are plenty of resources online that can do that for you. Comparative advantage is at heart an idea where a country has a relatively low opportunity cost when it specializes in the production of a good or a service, and providing certain assumptions are met, it makes sense for those countries to specialize in the products in which they have a comparative advantage. Now, if countries do specialize, if they do specialize, and assuming certain things, then specialization and trade can lead to more allocative efficiency, and more generally, it can enhance economic and social welfare. The word that I like to use in these kind of questions is the word capability. So yes, it's true that you can have in theoretical terms a comparative advantage in producing copper or oils. The key issue in the long term for countries is whether they can use the capabilities they've developed to make toasters and washing machines to produce other goods and services as the world economy changes. So if we look at countries such as South Korea, Australia, Germany, and ourselves, the UK, these are countries with a huge diversification of industries. There's not much that Japan or the United States or Germany can't produce. They have a very diverse trade pattern in terms of products. However, countries such as Zambia, and even more so Malawi, they have a much narrower range of output and exports. Their capabilities are more limited. And this is fundamental in determining their competitiveness and fundamentally how wealthy they become. I said I'd mention a little bit about the idea of vertical specialization. Now, specialization is used by A2 students in very general terms. I would hope that you would bring in this concept of vertical specialization. So what does that mean? It means that if you take a particular product, from an iPad down to a toaster, from a set of skis down to the computer that this presentation is being delivered on. In today's world, it's likely that the finished product itself, the product that you switch on or put on, is the result of the specialization at many, many different stages of production across the world. So we are seeing the emergence of vertical specialization along global supply chains. The best examples of this are the idea of Factory Asia, where increasingly countries such as Vietnam and Bangladesh assemble the products that are imported into these countries. We're seeing vertical specialization in the European Union in countries like the Czech Republic, with things like glassware, and Slovenia car making. We're also starting to see more vertical specialization in sub-Saharan Africa, and in particular, East African countries such as Ethiopia and Kenya are developing capacity and capability and fundamentally competitiveness in things like light manufacturing, which moves them up the value chain. Now that's particularly relevant to extract 5 when we come on to look at the fundamental structural issues facing a country such as Zambia. Here's our example of global value chains, the iPad. Literally, it says made in China, but actually only a small percentage of the price of an iPad actually goes to China in the form of an export. In fact, nearly half of the price of an iPad goes to Apple in the United States. And in fact, Korea takes much more in terms of the components it produces. So extract 1, if one stands back, is really about the economics of globalization, the economics of trade, and gets you to think about why countries trade, what are the gains as well as what are the disadvantages from trade and exchange. Just trying to widen the debate a little bit, here are some other aspects of the gains from trade. There's some quite strong evidence now that trade openness and success in developing export sales is hugely important for a country that wants to reduce the scale of extreme poverty. We normally measure that by the percentage of the population living on less than $1.90 per day PPP. So trade is important in bringing down extreme poverty, and the experience of China is clear evidence of that. Trade also at a micro level makes markets more competitive. To use an A2 micro term, it increases the contestability of markets, and that helps to bring prices down. And more generally, it means we get more rapid transfers of know-how and specialisms, the exchange of ideas as well as physical products. Trade is also a way of harnessing economies of scale, which in the long run increases productive efficiency and brings down prices for consumers. And fundamentally, if one thinks a little bit towards the sustainability aspect, countries are now starting to trade in ideas and physical products which are linked to sustainable energies, sustainable resource management. China, for example, is going to be the biggest exporter of green technology in a few years' time. So you could argue that trade also has environmental benefits going forward. The standout point really at the moment is that developing countries are taking a bigger and bigger share of world trade. The World Trade Organization last year published a report saying that since 1995, the share of world trade going to developing countries has risen from about a quarter, 26%, to nearly 40% in 2014. So why is trade so important for developing countries? Given that Zambia, Malawi are a key part of your case study for this exam, this is an important slide. Well, trade is a source of dollars, foreign exchange, and particularly those countries which are in the current account surplus, they can accumulate big foreign exchange reserves, which can be a very useful safety net. Trade is also a way of spending, creating the money, which you can then use to buy the imports that you need, the imports of technology, of capital equipment, your power supplies, for example. And if one goes back to the AS Economics of last year, trade, successful exporting is a way of injecting extra demand into the circular flow, creating export multiplier effects, and creating new jobs. Ultimately, one would hope that trade feeds through into growth, and then the growth itself feeds through into a stronger human development score. And fundamentally, trade is also a way of making markets more open, more competitive, and that brings down the real price of many goods and services, particularly if you open up the markets for telecoms and power. Just at the bottom of this slide, it's worth noting that if you just take the least developed countries, of which Malawi is one, their share in world exports is minuscule. Even in 2014, they only took just over 1% of total world trade. There are gains from trade for these countries, but equally there are also some disadvantages, there are also some risks. And this slide just tries to take you through quite a few of them. I think these are particularly relevant to when we get on to extract 4 and extract 5, and our focus switches very clearly to the issues facing the Zambian economy. So one of the big dangers of excessive or high levels of trade relative to GDP is the fact that the prices of the goods and services you trade might be volatile. And that in turn has significant effects for government finances, for the balance of payments. The export sectors that you might trade into could be susceptible to political uncertainties. Brexit, for example, in the UK at the moment, financial difficulties in the Eurozone, and developing countries as a whole tend to be more susceptible to swings in the global economic cycle. I think it's probably true to say that the less developed your country is, the fewer capabilities your economy has, the more vulnerable you are to global economic shifts and shocks. And of course, opening up your markets through trade you risk losing some jobs. You create some jobs on the one hand, but other jobs might be lost. And you could bring in ideas of structural unemployment there. Point 5 is quite important for OCR people this year. Zambia is a country with a very high dependence on copper, cobalt, and a few other natural resources. And there's a very real sense that Zambia as a country, whilst it's made significant progress in terms of per capita incomes, is at serious risk of the so-called natural resource trap. But more about that in a future revision session. I'm going to go through these slides fairly quickly. These are just 2 cover slides looking at the general advantages from globalization. We've talked about the advantages of trade from a developing country perspective. It's possible they could get you to talk in more general terms, evaluating globalization from a developed country perspective as well. But most of these points have already been made. I think the essence of opening up markets is that it drives efficiency, it creates a better allocation of resources, and fundamentally, hopefully, it makes people better off. Of course, there's no guarantee that will happen. On the other side, opponents of globalization, critics of the whole process argue that globalization is a major cause of rising inequality. It's also contributing to fast forwarding of climate change issues. It makes countries more fragile economically because they can suffer from the contagion effects. A recession in one country can very quickly spread to surrounding countries in terms of trade and capital flows. And generally, points 6 and 7 can almost lump together. And that's the idea that in a world of global brands and things and homogenous Coca-Colas and what have you, the opportunities for local niche bespoke producers might be limited. To what extent are we living in a world of harmonization and standardized products? I'm not going to spend too much time on this slide, folks, tonight, because I really want to focus on a couple of important aspects of Extract 1 in the time we have left. Another important contextual point, and again, please don't write all this down, just come back to it later and press the pause button if you want to make some points and some notes. But it's really important to understand that within the globalization process, we're also seeing the development of regional trade agreements, RTAs. 25 years ago, there were just a few. Now there's over 300 separate trade agreements. In fact, barely a month goes by without the announcement of another trade deal. Now, Zambia in green there is part of the COMESA free trade area, which includes Rwanda and Ethiopia. In fact, Africa has several overlapping trade blocs. You may be familiar with the emergence of Pacific Alliance in 2013, and more recently the signing of the Trans-Pacific Partnership, which includes Australia, Mexico, New Zealand, and the USA. The point I want to make here, the point I want to emphasize at this stage, is that globalization as a process is an incredible phenomenon, but there are rough edges, and increasingly countries are moving towards bilateral trade deals, agreeing trade deals with small clusters of other countries. We're moving to almost like a pocket, a balkanized situation where you've got many different centers of power and things. There's no unique world trade agreement at the moment, and that seems a long way off at the moment as we speak. Back to the extract. The extract talks about the benefits of globalization and things like advanced technology, cheaper imports, economic efficiency. So it's quite important in Extract 1, very important in fact, for you to be clear on what economic efficiency is and how the process of globalization could bring about a more efficient allocation of resources. What is economic efficiency? I hope you are familiar with these points. They should be revision for you rather than something that's new. But efficiency is basically when we make the best or optimum use of our scarce resources. And at A level, there are 4 types of efficiency to understand. Allocative efficiency to do with the price relative to marginal cost, the extent to which you get a competitive price in the market. Productive efficiency is when you have an output that's close to the lowest feasible unit cost. You don't waste resources in production. So that's linked to things like economies of scale. Dynamic efficiency is more to do with innovation in markets, more to do with the quality of goods and services and the choice available to consumers as their preferences change over time. And X inefficiency is the increased cost, the waste that comes from a lack of competition in the market. For example, when you just have a pretty cozy domestic monopoly. So for extract one, be familiar with the theory of trade, be familiar with the costs and benefits of globalization, and absolutely crucially for extract one, please revise the concepts of economic efficiency. Extract one also says that tariffs have been falling. Indeed, they have. The average tariff in the world is significantly lower than it was 20, 30 years ago. The areas in red are those with the highest average tariffs, in particular Russia and large parts of South America. Whereas in the European Union and North America, and increasingly parts of Africa, average tariffs are now actually quite low. So there's been some significant progress there. The extract provides you with this chart, quite an interesting chart. It shows the percentage of GDP that's taken up by the sum of exports and imports. So it's called the trade to GDP ratio. Now they've included Zambia, which is important because that's for later on in the case study. They've included Malawi, a very poor country, very low and small income country, and two bigger countries, Brazil, one of the BRICS, and Australia, an OECD country, of course, which is one of the few countries to have avoided recession since 2007. So just briefly looking at this data in terms of the chart and things, the outlier is Malawi. In fact, their trade to GDP ratio has gone up from about 70% in 2011 to over 110% in 2013. So there's clearly a significant change there which needs to be explained. Zambia's trade to GDP ratio has been fairly stable, but actually over the period it's dipped by about 3%. Australia, we'll come back to Malawi in a few minutes, folks. Australia has a much, much lower trade to GDP ratio. Slight quirk is that in 2009, their trade to GDP ratio went up, whereas other countries it was falling. And the main reason for that was because Australia was riding on the coattails of a booming Chinese economy. It was selling a lot of iron ore and a lot of coal and increasing a lot of farm produce to the fast-growing Chinese economy. So Australia, in that sense, managed to buck the trend in 2009, been pretty flat in terms of the trade to GDP ratio since then. What I've done in this chart is just reproduce the data for you and put it into different colors and things. Again, you can see the Malawi trade GDP ratio 100%. Brazil, one of the BRIC countries, middle income nation, again, a rise in trade to GDP, but actually relatively low by international standards there. So just a quick word, if I may, on why countries can have a trade to GDP ratio in excess of 100%. This sometimes gets students thinking a little bit. How can that happen? Well, keep in mind that all we're doing here is we're just adding together the value of exports and the spending or the value of imports. It's simply X plus M and then dividing by GDP. It's not the familiar X minus M, that gives you the trade balance. This is just X plus M, total value of trade, divided by GDP. And what's the big story here? The big story for a country like Malawi is really quite simple. It's an incredibly small economy. And therefore, if its exports rise, then the trade to GDP ratio will rise pretty quickly. And if the money it makes from exports are then immediately spent on imports, then the trade to GDP ratio rises even quicker. And I'm pretty sure that's what's happened in the Malawian economy. The economy has continued to grow. It's not a fall in GDP. Some people have been arguing. Malawi has continued to grow. It's just that their export sector has grown quickly and they've spent the money on imports. Countries like the United States, like Australia, like the UK, we have a lower trade to GDP ratio because we are such bigger economies in absolute terms. Now, Malawi is just worth a couple of minutes of a revision. Everybody's going to be focusing on Zambia, chosen deliberately by the examiners because it's extremely poor and it's adjacent. It has a common border with Zambia. It's one of the smallest countries in the world. Put it in context, its annual GDP per capita, its annual GDP per head, is the same as the profits that Apple makes every 10 days in dollar terms. So it's an extremely small economy. In fact, it's an economy which produces only 0.01% of world GDP. So it's an economy which is very, very small. And over the last 10, 15 years, its per capita income has risen, but Zambia's has risen much faster. And that's perhaps an interesting compare and contrast for you to think about there. If one looks at Malawian exports, you can see a very common pattern emerges here, that they are highly dependent on exporting tobacco and tea, uranium and thorium ore. So, less than 10% of Malawian exports come from manufacturing. 90% plus comes from the primary sector. They are highly primary dependent. But yet, if you look at their imports, then we get a much more of a patchwork quilt effect, as you can see here. So Malawi has to import fertilizer from South Africa. It has to import petroleum and vehicles and telecoms equipment. It's the classic story of a very, very poor developing country, which is growing, but it has to export a lot of tobacco and tea and uranium. It has to export a lot of that to pay for the imports of fertilizer, medical equipment, petroleum and vehicles. The terms of trade are likely to be against the Malawian economy. Now, Malawi has seen a significant rise in trade to GDP, no question about it. Part of the answer is that they're starting to get their act together in terms of raising farm productivity, which is good news. And the other big story in Malawi in recent times has been the rise of tourism. Some significant investment in the Malawian economy, including some foreign investment from hotel chains and eco-tourism and ethical tourism. And I think there's a line there that you could use in your extract 5 question, that Malawi has done well in terms of developing a kind of sustainable tourist sector, which has higher value added, and it could be an important pathway ahead for the Malawian economy. However, if you take the bigger picture, if one takes half a step back, if one looks at competitiveness, then Malawi is one of the least competitive nations on the planet. Overall, there's only 5 countries with less competitiveness than Malawi. Indeed, in terms of macroeconomics, it comes bottom of the pile. So this is a factor-driven economy, very poor, that's making some progress, but there's clearly a limit to how rich this country can ever become. Finally, the extract 1 talks about the slowdown in the growth of world trade and the fears and worries that this was going to lead to protectionism, etc. Now, clearly, this is, again, a key aspect of OCR. They like to test your understanding about protectionism, about the costs and benefits of different forms of import control, and those kind of things. You can see from this chart that in 2009, we saw the biggest actual fall in world trade for 20 years. The world trade in goods and services fell by 12% in 1 year. They recovered pretty quickly in 2010, which is just a rebound, I suppose. But the key point from this chart is that the growth of world trade since 2011 has been half the growth from the period 1990 to 2014. We're currently in a phase where the world trade, growth of world trade is much, much slower than it has been in previous years. And some people are using this as evidence for the end of globalization. Here's the data. There's the big fall in 2009, minus 12.2%, the big rebound in 2010. But since then, indeed, since the extract's been published, the growth of world trade has really slowed down. What does that mean for countries like Zambia, for whom copper and other primary products are an absolutely essential part of their economic fortunes? So why is world trade slowing down? Some people think it's because of what's called secular stagnation. Secular stagnation is the idea that the rich nations of the world, Japan, United States, ourselves, they're going to be growing at a new normal rate, which is significantly slower than in the last 2 decades. Another aspect is that the Asian economies are again now slowing down. We see this happening in China. We see this happening in a range of other countries. And because they're importing, as their economies slow down, there's a knock-on effect in terms of investment demand for raw materials and components, what have you. We might also argue that many of the big cuts in tariffs have already happened, and average import tariffs are now so low, there isn't much scope for cutting tariffs much further. Indeed, what we've seen happen in recent years is the fall in tariff barriers, but the rise of non-tariff protection. And we'll mention some examples of that in a few minutes. And generally, as the world gets richer and extreme poverty falls, which is good news, undeniably so, people tend to shift their spending away from food towards services, education, leisure time, health services. And actually the evidence is that trade in those things for the moment is actually less as a share of GDP than trade in things like cars and iPads. And that could change, but basically services are traded less around the world at the moment than are commoditized manufactured goods. So there are some reasons why world trade isn't quite growing as quickly at the moment. As part of your analysis for Extract 1, you'll have to have a good theoretical understanding of the effect of a tariff. This diagram is just to remind you of the tariff diagram. I'm sure you'll have it already in your notes, and please work through them. They're important to consolidate. The point I want to make to you in this revision session is that tariffs have welfare consequences. So it's important as part of the evaluation to think about the consequences of an import tariff on consumers, both the final consumers of a car or another product, as well as the producers who need imports. So car producers need steel. So there's a tariff on steel. There's a consequence for car manufacturers as well. But there's your basic analysis diagram for a tariff. And keep in mind that tariffs overall have been coming down, but non-tariff barriers, NTBs, have been growing in frequency and intensity. And what this slide does is it takes you through a few examples of classic non-tariff barriers. So classic things are things like technical barriers to trade, making labeling rules and product compliance extremely tough, extremely costly to meet. Examples could be things like state aid, domestic subsidies, 0.5, where government gives some state aid to an ailing industry. Increasingly, non-tariff barriers are moving into the areas of murky protectionism. So hidden rules on health and safety, rules on investors and takeovers and that kind of stuff. And you could also argue that increasingly central banks are starting to use exchange rate manipulation as a form of import control. All of these things would be captured by the term non-tariff barriers. And again, the key takeaway point is that these barriers are generally speaking on the increase at the moment, even if import tariffs have been falling. And so it's important, I think, to understand finally what the motivations for protectionism are. Why might countries be encouraged, forced, cajoled into introducing protectionism measures? We know at the moment the steel industry in the UK is complaining of dumping of steel from China. We'll talk about trade deficits and things in Extract 2 in another session. Governments trying to protect strategic industries and the jobs in those sectors. And governments wanting to protect the emerging fledgling infant sectors with some temporary controls. For developing countries, protectionism is a key source of tax revenue. And typically protectionism tends to grow when countries are in recession, facing big trade deficits, and governments are under pressure politically and socially to do something about competitiveness. On the other hand, it's important as part of the evaluation to think about the arguments against trade barriers. And this is where you can bring in some relevant game theory to your A2 analysis. In particular, the risk of retaliation by countries affected. The arguments that subsidies and tariffs actually distort the allocation of resources and lead to market prices not fully and fairly reflecting comparative advantage. Ultimately, of course, tariffs and quotas create higher prices for consumers, and so we could then talk about the impact of higher prices on income inequality and the real incomes of poorer families. If you put in trade barriers, that immediately creates incentives for people to bypass import controls through black markets and shadow markets. And the point I made before about exporters, that oftentimes an exporter in today's vertical supply chain, the export of a car or the export of some machinery, has to import many different components from around the world. So if you're introducing a tariff, they are also affected badly by that. So what we've done over the last 35 minutes is go through some of the economics of the first extract, the first of 5 on the OCR 585 toolkit for this year. Our focus tonight in this first session has been on globalization and trade, and what I've tried to focus on in particular is the importance of trade for developing countries, the risks and the advantages of those countries participating in an increasingly globalized world. Hope that's been useful. I'll be able to reply to questions posed during the webinar, and I'll do that separately once this is finished. So please tap away. There are lots of revision resources, free resources to access on our website, tutor2u.net/economics, where you'll find details of all the future revision webinars. I'm very happy to answer your questions and continue the conversation on Twitter. My Twitter handle is @tutor2ujeff, and it would be great to help you in your revision as you approach these important exams. For the moment, thank you so much for joining in this intensive revision webinar on Extract 1. I'll bid you good night and say thank you for joining me.